Hi, welcome to Market Minute. The college football playoffs is coming. That's going to be so much fun. I can't wait. It's really strange how they seeded these teams, but it's going to be a lot of fun anyway. Um, are we in a new market paradigm? Quote the emotional cycle of the markets, where everybody thinks it's different this time. So we have some charts to go through. It's interesting. If this CPI report on Wednesday is in line with expectations, we think the Fed's on ice. And then we want to walk you through some of our best stock ideas. So companies that have real good value and have good upside potential may not be in that new paradigm phase of the overall market, but are good quality companies that should do well over time. So the stock market update. The CPI report on Wednesday is expected to be up 0.3% versus October. So that's a 3.6% annualized rate. That's high. The October report was year over year up about 2.6%. Energy prices have been a help to bring down the inflation, but the wage growth is not allowing the CPI to come down. We've said this over and over again. You need to have a recession to meaningfully bring down inflation or to kill inflation off. So that's not happened yet. So inflation's sticking around. The CPI report will be interesting because the Fed meets next week, is expected to cut by 25 basis points to get the rates down more towards where the 2-year Treasury is. The 2-year Treasury is at 4.11. The federal funds rate is currently about 4.6. So it gets them closer to where they should be. They may want to cut again sometime next year or not. We think that they're kind of in the right zip code of where they should be now. Um, we do think in general it's going to be tough for the Fed to cut more than what they've already done. So if you bring it down below where the 2-year Treasury is, bring the Fed funds rate below the 2-year Treasury, the 10-year yield is going to go up. So the bond market is not convinced that they should be cutting much more than what they already have. Otherwise, they're going to rekindle inflation. Now, we mentioned this last week. The NVIDIA CEO, I've been wondering about this for a while, said that he said this a while back, but we mentioned it last week and mentioned it this week because I think it's an important point, that the NVIDIA CEO said there's a $1 trillion opportunity in replacing the CPUs, computer chips, with the GPU chips, their chips. So basically, replacing the Intel chips basically with their chips, that there's a $1 trillion opportunity in doing this. But the market cap of Nvidia is about 3.3 trillion. So you kind of have to scratch your head a little bit. How's an investor going to get paid back? So the stock may be overvalued. And if we're in this new paradigm phase, I'll walk you through this a little bit. So this is where smart money, this is where I think I invest, right? Institutional money, when the cycle turns up, this is where they're starting to getting into the right stocks. And then the public, when the public really gets involved, this is the mania phase. So not sure where we are in this, but we are well past enthusiasm. We might be in that greed phase. Delusion is possible. That's very possible. We might be all the way up here at the high where people are thinking this AI is a new paradigm. It's going to drive everything really positively. But we know there's a difference between stocks moving up, the expectations of things occurring, and real, business cycles, people implementing technology and getting some revenue off of it. And then just keep aware that you've had this strong emotion up. You get the same sort of thing on the way down if it doesn't play out. So we had a chart out last week that showed the earnings trends of the market, call it this line here, and then how much we are above the earnings trends of the market. how much PE expansion has occurred. So we're roughly about 22 times 2025 earnings. There's an old rule of thumb called the rule of 20. So if you take 20 minus the kind of longer term expectations of inflation, say it's 2%, that gets you 18. We're 18 times earnings. So we're roughly 20 times, 2.6%. That's 17.4 times. That's probably more likely to occur. The market's at 22 times. So it's kind of having this delusion or new paradigm sort of feel to the overall markets, in our opinion. So the average stock in the market is pretty reasonable. It trades right around that 17 times, 18 times earnings. And then the more you go down in market cap, the more, the more value you get. So we like small cap, mid cap stocks because that's where the value is in the overall market. Now there's a strategist, his name is Adam Parker. He recently said this, and it kind of floored me, that a strategist would come out and say this. He said that when Taiwan Semiconductor says we can supply NVIDIA with the chips that they want, so it's in balance, supply and demand is in balance, then the market would fall significantly. I usually don't quote out strategists. They don't come out with these sort of comments. I thought this was really interesting. It's really insightful. This guy used to be a semiconductor analyst. I think that's a really insightful comment, something to keep in mind. Where we're finding stock ideas is outside of technology. So in other areas of the market, we want to give some ideas to you. So just a normal correction in technology, because technology is such a large portion of the overall stock market. I mean, it's darn near 50, almost 50% of the S&P 500 if you include all of the other technology-related stocks in there, like in the communications sector. So it's a really large part of the overall market. If you just get a normal correction in those stocks, if you get a normal pullback, it could cause a bear market decline. So as expectations have gotten so high, just a normal pulling back in those expectations more to reality could cause the market to fall considerably. Now, large mutual funds and hedge funds as well. And so how these large funds operate is that when things are going up, they got to go with it. They got to compete. They got to get the same return. So everybody gets plowed into the same stocks. That's what's happened. The hedge funds aren't too different, but they have more tools. They can take the NVIDIA position and then short against it AMD and still get a really nice rate of return. But they have that downside protection in place. And then when the NVIDIA stock starts to fall, they may short that as well, but they'll take off their long position in NVIDIA and then capture the downside. So just keep in mind what these large funds are doing right now is they're playing that momentum phase until it breaks. And then when it breaks, they're all going to have to react to it. If the Trump policies are put in place, we think it really favors the small and mid-cap stocks that are the cheapest stocks in the market. So that's what we want to focus on. And then for longer-term investors, many of the blue chip stocks are trading like the rule of 20, like where they should be. They're valued where they should be. So some of the stocks in the blue chip area that we like, there's not a company that's any more blue than J&J, right? Here's a chart of J&J. So this is a 5-year chart. It hasn't really made any money. There's been some trading opportunities in it, but you can see it's right around the support level currently over the 5 years. It's starting to trend up. It broke the trend, broke it a little bit, back down to I think a really nice buy point. This might be a nice stock for 2025, 2026, and then Pfizer starting to get better. They over-earned in the COVID phase. Now their drugs in their portfolio are starting to reaccelerate. 9 times earnings. That's pretty interesting with a 6.5% dividend yield. Lilly's pulled back. Boy, has it ever. RFK's really provided an opportunity in Lilly. You can't stop these GLP-1 drugs. This is not possible. So we see Lilly has a nice, really nice pipeline. It's pulled back nicely. We're considering it as a buying point. ASML, okay, there's a tech stock. Why we like ASML is they have a monopoly on those high-end, really tough design chips. So they're a semiconductor equipment maker. So you need their equipment to make these high-end chips. At 28 times earnings, that sounds high, but for this company, it's not. So this company's traded close to 50 in the past. So we like ASML. Again, this is a kind of couple year sort of outlook for this stock. Adobe, they're going to be a beneficiary of the build out as they have content. So we like Adobe. Adobe looks like it's an interesting point. DTE is a utility. They're going to benefit from higher electricity demand, only 17 times earnings. Target, okay, Target stubbed their toe. We like when these quality blue chips stub their toe. 14 times earnings. We think the outlook for next year is kind of interesting. This is something that we want to buy. Haven't bought it yet. So at 14 times earnings and improving business trends next year. Compare that to Walmart. Walmart's a better company, granted, but it's at 34 times earnings. So if you're a hedge fund guy, you're thinking, okay, Walmart's a momentum stock. When that momentum breaks, I want to short Walmart and buy Target. Raytheon, big supplier of arms. They're the arms dealer of the world, right? To the good guys. So we bought this, when it was really cheap. It's come back nicely. This is a quality stock to put in your portfolio. And the food companies have been really hit hard on RFK being nominated. Hershey today, we own some Hershey. That was nice. So Manalese is out talking about acquiring Hershey. We think that Hershey business is a really good business. But if this occurs, we think it's going to spark an M&A trend in the food group. We're going to see more consolidation. In the small mid-cap stocks, Dollar Tree, this is a good company. Sells at 12 times. We think the momentum will come back in their business. So it normally trades at 18 times earnings. That's a 50% move to get the valuation back where it should be. Grail, we talked about this a lot. We think this is a huge winner over the next 5 years. Avondale, okay, I want to talk about this one. They have a narcolepsy drug. It's so much better than their competitor Jazz. Jazz tried to sue them to keep that drug off the market. They failed. This is an really early stages of them rolling this drug out. You can see the chart here. It's pulled back on kind of a sloppy quarter. Not worried about it at all. At $10 a share, we think that there's 2x to 3x upside in this stock. We think it's going to get bought out. So this is the type of company. They have a good drug. It's on the market. Nobody can compete with them in this sector. We think somebody comes in and buys them. Veru, okay. So BioAge just got torpedoed to the downside today. BioAge is the only one that we know of. It has a competing drug. It's very different from Veru's. It had a market cap of 700 million. Okay, so what their drug does is it was trying to get into that lean muscle mass. So to use it in combination with GLP-1 drugs. So Veru has the only drug out there that looks like it's going to work. They're in a phase 2B. That data will come out in January. What the management team at Veru has been saying is that they're not seeing any significant dropout rates in their trial, which means they don't have the side effects that BioAge has, which killed their drug. So BioAge went from 20 today on Monday down to less than $5, all in one day as that drug didn't work. Lilly was sponsoring in collaboration with BioAge. So it's going to, this is a big positive for Veru. So someone's going to buy Veru after the phase 2B results in January, maybe buy them. And we think worst case that they come to the market and they raise $100 million or something like that. They do a big raise to do their phase three, or they're bought out. So Veru is very interesting to us. So just keep in mind, we might be at a speculative high in the markets. It's worth noting. Maybe there's some momentum, but we think come after the first of the year, some of these stocks have done so well, you're gonna see profit taking in them, and we'll see if there's a rotation. So if Trump gets his policies in place, you're gonna see a rotation to the smaller cap stocks, and there's some really interesting blue chip and small cap names to buy. Thank you very much.